Is money interest still there for the market, Nitin, or has this interest rate hike and a fairly poor earnings performance sort of put us off the radar for a while?
Again, I think if you see global situations, we've been on the lower end of not just performance as an equity market. I mean, we've probably been at the bottom of the barrel over the last 6 months since November of last year. And the only situation when that can change is if the correction in global commodity prices is sustained a little longer. We've seen the second bout last night. If that happens, I think we'll start getting a little more reallocation given the prospects for our earnings will improve. But on the flip side, I think the general flow from EMs will mute anyways. I mean, today we are getting less flows than some of the smaller Asian countries, and that should tell us something about the appetite for Indian equities globally. Domestically also, I think the flows are fairly muted, given that there is a very less incentive for people to put risk capital at work when they can get double-digit returns out of fixed income securities at pretty much a very low risk environment. So I think until, as I said again, until that interest rate cycle starts to peak off, I think any sustained rise in the equity markets is not likely to happen.
Nitin, how do you approach defensives in your portfolio now, especially FMCG stocks like Lever and ITC?
Again, I think the staples obviously have a slightly better outlook over the next very short term, next few weeks and months, given the interest rate impact on the discretionary items. So, issue really is, can you find value? Can you clearly see that they're inexpensive? And I think at this point, it's a little hard to find value in most of the consumer staple stocks.
Nitin, what is the best way to approach these oil stocks? I mean, they have rallied in anticipation of the event and some price hike. Any sense of how you would like to play upstream and downstream, given expectations and given oil prices?
I think again, if you kind of break them away into their respective segments, I think if you take Reliance on one end, clearly it's at the bottom of its trading zone and has almost always given a 200-250 rupee return from that level. But again, the other OMCs, as I said, I think are reacting to speculation around the event, and I think till such clarity comes in, while it might be prudent to kind of take exposure at lower levels, I don't think it's prudent to kind of speculate on the event and trade. I mean, at least that's the view we've taken. We've had some exposure to some of the OMCs, but that's because we've been building a position over the last few months, more as a contra bet, more as a long-term valuation play. And I think we continue to kind of stay focused on that kind of a play rather than any news-driven play right now.
Nitin, on that point you were making about liquidity, Asian long-only funds, and I'm not talking about hedge funds or ETFs, they've closed up their worst quarter in a long time, and a lot of it is to do with the India exposure. Is it more hope than conviction right now that one wants to see a rebound in this market and a rebound in liquidity?
I think again, most of over the last 6 months, the trade really has been developed markets over EMs, and again within EMs, it wasn't really to carte blanche EMs. I mean, even if you see ETF flows or global flows, DMs have actually had a much larger share of inflows, and most emerging markets have either had flat to negative flows in there. So I think, as Udin was mentioning, I think it's a double-edged sword, because in the short run, despite the fact that the longer-term outlook for emerging markets will get better with falling commodity prices, I think in the short run there will be pain, and it will be primarily because of the suck out of liquidity from almost every risk asset class, including equities and commodities. So I think that's really what we need to watch out for. And will the flows recover sharply in favor of India? I don't think in the short run they will, but I think as things, as that buying opportunity hopefully materializes, I think we might just see a reallocation of capital, and it might just again become in favor of markets like ours, which are actually net gainers with soft commodity prices.